Hello, my name is Luke, and I work for AccuFi. I am the lead designer and engineer for Tess, our tax equity partnership spreadsheet model. Tess is fast and accurate and easy to use. Since we're so excited about it, I've been making videos to help people learn Tess so that they can use it to run scenarios for their own projects and partnership models. In this video, we will be talking about some of the most important partnership level settings in Tess. This model already has a project model in it. If you need to see a video on how to add a project model to your version of Tess, I have another one that I can link in the description. Okay, so without any further delay, let's get started. So I'm on the partnership settings tab, which is down here. In previous videos, I've kind of skipped over this tab and promised to make a video explaining more about it. This is that video. So what I'm going to do is just go through some of the big settings, the ones I think people are going to want the most help with, and we'll just talk about each one in turn. I'll kind of talk about how it works, demonstrate how to use it, show some things that you might want to know for your use of Tess. Okay, so the first one is projects. Tess has a feature in which you can mark streams. When I say streams, I mean like rows on the depreciation tab, on the project to partnership tab. You can mark them as belonging to a particular project. And while this is a little bit more work, it's really nice because it allows you to easily enable and disable projects to take them in and out of the model just by changing one cell here. Tess comes with 2 projects in by default, but of course, as with many scalable sections in Tess, you can insert more rows to add more projects. So there's just 2, but if you add more rows here, you'll be able to add as many as you like, and they'll all work. So to see how this works, right now, if I go to the Project to Partnership tab, all of my inputs are set to project 1, and by default, project 1 is all of the inputs. Same on depreciation, it's all project 1. Okay, so let's move a stream to project 2 just to see what that does. So I'm going to take this uncontracted recs row here, this one, and I'm going to set the project to 2. And you get a nice little drop-down menu that actually scales and updates when you add more projects, which is kind of cool. So I just set the cache into project 2, and I know that this isn't going to work, but I want to demonstrate what happens when you do this just so that you can see it. So if I go to the partnership settings, and now that's been marked as project 2, if I now set this to disabled, so now I got checks failing when that happened. And this is actually really important. So what I did, I know in my head why checks are failing. Well, let's go see. So if I go here, I can see, all right, sponsor capital account doesn't go to 0, and sponsor basis doesn't go to 0. And partnership capital account doesn't go to 0. Okay, so this set of check failures, especially the partnership capital account not going to 0, to me is a sign that the amount of cash and the amount of tax in the deal is not equal, because to have a valid set of inputs, you need to have an equal amount of taxable income as you do to cash. And you might already be thinking, oh, I can see how we might have messed that up. What we did was we set the cash values to project 2 and then disabled it, as you can see in this cell. But we didn't do the same thing with the taxable revenue. So we have $20 million more dollars, $21 million more dollars of taxable revenue than we do cash currently in the partnership. And Tess noticed that, and it said, hold on, something's wrong. You need to go fix this because something's off, something's out of balance. And the thing that's out of balance is cash has to equal TI. That's very important for Tess and really for all models. And Tess will tell you when you've messed it up. Okay, so all I need to do then to fix this is just also put the taxable revenue stream into project 2, and then look, it just goes back to okay. So everything's fine again. You may notice that you might have expected this model okay. You might have expected this to turn yellow because the model does need to be rerun. We changed the inputs. The truth is that this cell often detects when something has changed, but not always. So if you know you've changed some inputs, I recommend clicking run no matter what, regardless of whether this says it's okay or not. So let's just click run and go to the dashboard. Okay, so cool. So we now took those recs out of the project. Let's keep an eye on an IRR and see the effect. So like if we look at, say, this sponsor full-term pre-tax IRR, right now it's at 4.05%. If we go to partnership settings and then we put this project back in, interesting, checks are failing. But again, kind of like with the model okay, not always turning yellow, if you change an input and some checks fail, run the model first and make sure they're still failing afterwards. Okay. And then yeah, okay. So checks are okay again. So if really like if you know you've changed an input, something's different, just run the model regardless of what these say. If they still say something after the model has been run, then you might have a bigger problem. Okay, so to check, this said 4.05 before, now it says 5.33. So we know that it worked. We know that we managed to take that cash and TI out and we added it back in. The deal got a little bit better. The returns got a little bit better. Okay. And then actually in some further on in this video, we're going to look a little more closely at how you can see the effects of cash like this, or really changes to streams being in and out of the partnership calculation. Okay, cool. Okay, let's move on to the next topic, which is contributions. I'm really just going to be going in order of appearance on the partnership settings tab. So we did projects, now we're going to do contributions. So similarly to projects, you can scale the quantity of contributions that you have. Tess comes with 2 to demonstrate that there can be more than 1. You can insert rows here and have as many as you like. But let's, just as an example, let's walk through this a little bit. And as an example, we'll change it to see what happens when we do something. Okay, like other input streams, there's a project setting. This is always a formula that's reading whether the project's enabled. We have a total amount for this contribution. We have a share for partner 1. It says P1. It's really whoever partner 1 is. It's usually the investor. Really should be the investor. Tess kind of assumes that it is. So that's set to P1. You can change these names, by the way, if you like. Okay, so that's set to P1, and then the date. I want to talk a little bit about the dates because this is a question that's come up a few times. You can put any date that you want in here. So it can be a date before the partnership starts. It can be the partnership start date. It can be after the partnership starts. It doesn't have to be on the end of the month. It can be any day in the month. And Tess will automatically use that date when it computes returns, which is something that's really cool because this is something that I've seen a lot of models struggle with, is how do you handle the non-end of month dates for contributions, or the fact that they happen before the partnership starts, or whatever it is. So if this date is before the official tax equity partnership start date, it's not a problem. Just put in whatever date you want and it'll work. Right now it's set to the start date. We'll go back and change it later. This year, this is just a formula. A month, those are formulas. These are useful in computing the return. The P2 share, so this just is the total minus the P1 share. And then there's a bunch of stuff over here for contributed property that we'll just leave for now. Okay, then we have another row. So what we have right now is we have just 100% of the contribution on the start date of the partnership. You can see this formula is equals start date. So let's now change this to, let's change it so that we put in 80% 3 months before the partnership starts, and then the other 20 on the partnership start date. So I'm going to go ahead and say, all right, so this amount, we have the FMV times 100%. Let's make this times 80%. Okay, it's taking a little bit to calculate. It's been taking a little bit today. All right, so that changed. Some checks failed, some things changed because we messed with the inputs, but we'll put it back. All right, so this start date, we'll do EO month -3. And what that'll do is it'll take start date, it'll back up 3 months, and then just use whatever date is the end of the month, 3 months before this one. Okay. Actually, maybe for fun, maybe we'll demonstrate the fact that this doesn't have to be an end of month date. So let's put it on 12/5. We'll just hard code that. Okay, cool. All right. let's go on to the next cell. So what I'm going to do is I'm going to copy these down, set this amount. This was 80%. I'm going to make it 20. All right, cool. So now just eyeball checking these two, this down here sums to 169,015. That matches our FMV, and our checks turn green. That's all good. So all this looks good. So like I said, even though these are green, let's just rerun the model anyway, just to be safe. Okay, go to the dashboard. Okay, so it worked. Everything seems to be in order. If we do, I think if we look at the P1 cache tab, yeah, this is helpful. So over here, these gray tabs, these show outputs for the partnership. So if I click on P1 cache, it'll show me an annual summary of Partner 1's cache. And you can see in the year 2020, we have this negative equity flow. And then in 2021, we also have a remaining amount of equity. And you can see also that the other partnership flows haven't started in 2020. They start in 2021 the way that we'd expect. So it's kind of cool, kind of some proof that it did what we wanted. Okay. Okay, so that's how the contributions section works. Like I said, if you need more contributions, just add more rows here. Make sure you copy each row when you do it. If you have multiple projects, just add more rows, assign the contributions to the project they're associated with. It'll all work. It's all very smooth for editing this. Okay, so I'm gonna put actually what I'm gonna do is I'm gonna put this back the way it was, because we're going to do some other things with the equity that will necessitate, well, they really just are more common with 100% contribution on the start date. So I'm going to change this to start date. Okay, all right, so that's back the way that it was. Let's run it just for good measure. Okay, cool. All right, looking good. Okay, so that's contributions. Now let's talk about splits. So Tess has a somewhat unique, I would say a definitely unique approach to handling splits in the partnership. Most models that you see, they'll do something where they kind of hard code which rows are split in which way, or they'll have something where they say that there's like a normal set of splits and then there's an alternate set of splits, and some of the project flows go into the normal one and some go into the alternate one. But Tess is a little more rigorous about it than that, and it has this concept of schedules where you have 4 possible schedules that you can use to assign different rows to in the project to partnership tab. So starting at the most simple example, cache split 1, okay, on the start date, we have 10%. There's a formula here actually which will be the earlier of the flip date, the actual flip date and the target flip date, which can be useful for putting in a cache step up, which actually is what this formula is doing. So this handles a cache step up. And then this is the actual flip date. The fact that this data is repeated is not a problem. Actually, the formulas handle that just fine. So it's okay to have a repeat like this. You do need these to be in chronological order. If they were out of order, that would cause a problem, and I would expect it not to work. Okay, so that's our first schedule of splits. We also have schedule 2, start date 5%, just 5% all the way out to the end. Same kind of setup in TI. So we have this first schedule. This is start date 99%, and then on the flip date, it goes to 5. And then schedule 2, kind of like cache schedule 2, you can see the default is just 5% all the way out. Okay, so let's go look at how this is used. So if we go to the project to partnership tab, what we can do, let's set these back to being in project 1, even though we know it didn't really like affect anything, but just for beauty, let's do that. Okay, so see how there's this cache split input here? We can select which schedule we want for each row, which is really powerful because now you can just have an arbitrary number of rows. You can arbitrarily assign them to split schedules. You don't need to do this in a formula. You don't need to like write a formula that says, okay, include this, 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 this. No, you can just select it here from these nice little drop downs. So let's put the uncontracted recs into split schedule 2 for cash. And actually, let's do it for just for cash at first, and that'll work actually because this is a special allocation partnership. We're allowed to separately split cash and tax. We can do whatever we want, so this will work. This turned into need run, which is a good sign. So let's run it. I'm going to just do stay here. And what I want to show you now is this allocations tab, which is down here. So in the allocations tab, this is the TI area. Okay, so I'm on the cash splits section of the allocations tab. And this is a report that shows you exactly how each schedule is flowing through the model. You can see this is an annual tab, so it's a summary for each year. And you can see the amounts that are in Schedule 1. So this is like the total. And then the amounts that have been allocated following the splits to each partner. And you can maybe eyeball the fact that the split drops down to 5, goes from 10 to 5. Maybe not, but anyway. Okay, so you can see we have some amounts in Schedule 1, and then we also have some amounts in Schedule 2. And maybe just for fun, let's go check this. So this is like partnership amounts. The total for the partnership in 2021 is 483,156, and you can see it's split this way. Let's go check that number just for fun. So if we go to project to partnership, uncontracted recs, and we add it up, 483,156. So that's a nice little proof that the cash split 2 numbers are the uncontracted recs. And then there's one more cool feature of this report I want to show you, which is this little drop down. If you set this to yes, it'll show you the percentages instead of the amounts. So you can have a proof that the percent is what you asked for. And you can see this goes from 10. There's a funny split here because this is the flip year and it changes in the middle of the year. So that's kind of nice. And then it switches to 5. Okay. And then there's reports for all the other schedules, but they're hidden. You can't see them right now. Okay. So this is a place that you can look to see how numbers are flowing through the model without having to actually unhide the partnership model tabs and start picking through the formulas. This is a little bit easier. Okay, so let's go ahead and change. Oh, I clicked on the wrong project. Let's go ahead and change this TI split schedule to also be Schedule 2. And we'll rerun just for fun. And I want to show you, I'll show you briefly. This is a little bit of repeat. I'll show you briefly on the taxable income split section. We have the same concept where this one's a little more thorough because it separates out revenue, expense, depreciation, and interest. So it's a little bit more going on, but you can see we have these are our same uncontracted rec amounts. And you can also see the allocations for TI are a little more complicated because of effects from debt and other things. And then same kind of thing, you can set that flag, you can see the splits here and see the splits here and have some tracking of how both cash and TI are flowing through the partnership. Okay, so that's how the splits system works. I showed it to you on the project to partnership tab. It also applies on the depreciation tab. Oh, no, it doesn't. Just kidding. Take it back. It doesn't apply on the depreciation tab. I think depreciation is always set to split Schedule 1. So depreciation will always go on Schedule 1. You don't get to set it in here. I've never encountered a partnership where that wasn't the setup that they wanted. So I think that was a pretty safe bet in the setup of Tess. Okay. Okay, so let's move on to our next topic, which will be PAYGO. So if you're not familiar, PAYGO is a partnership construct in which instead of putting in all the equity up front, the investor puts in equity over time during the partnership's operation. It's usually associated with production tax credits, and the amount of equity that the investor puts in each year is dependent on the amount of production tax credits that have been earned by the partnership in that same year. So Tess has a pretty basic PAYGO calculator. There's some sophistications that I've seen to PAYGO calculations that Tess doesn't really have right now. In theory, it could in the future, but if you have some fancy PAYGO calculation that this doesn't want to do, or that Tess cannot do, then then we can support that as well. So you can see that there's 3 modes. There's off does nothing, there's calculate, and there's specified. So Tess, you can use Tess's calculator, or you can just specify your own calculation. PAYGO is not a calculation that's strictly related to the partnership. Actually, you could do a whole PAYGO calculation in your project model and then just specify the amounts in Tess, and Tess will use them. So if you find that Tess's calculator isn't doing what you want, you're free to use your own calculation. But I'll show how to use Tess's calculator just for good measure. Okay, so we set this to calculate. There's this whole set of inputs. Baseline percent of base case PTCs. It's kind of a mouthful. So for the PAYGO calculation, Tess expects to have an input of baseline PTCs, which these are the PTCs that I think it's typically the P50 case, that you expect to get, and then you're going to multiply them by this percentage, 75%, and then look at the difference between that percentage of the baseline and the actual PTCs, and pay PAYGOs on that difference. That's generally how the calculation works. I've seen many variations of it, but that's really the basics. So when we do this, we need to set up the baseline PTCs. So there's a place for them on the Project to Partnership tab. If we go to PAYGO and capital transfers right here, for calculated PAYGO, we have baseline PTCs. Okay. So it's important that these are usually like the PTCs in the P50 scenario only. So we got to be a little bit careful. If we set up a formula here and then we change the scenario in the project model, PTCs change, that's going to be a problem because we really want to set these. So what I'm going to do is I'm going to go to my project model down here, and then I'm going to take my PTCs. Oh, look, I've actually done this in the project model. So I've already taken these P50 amounts and I've hard coded them here. So what I'll do is I will just point the formula to these hard-coded amounts. So that'll be good enough. If not, I could just copy this entire row and then paste the values into the Project to Partnership tab. That's also an option. Okay, so here I'm going to say equals project monthly, this hard-coded number, and paste. Do a little total check, 129.74. Oh, wrong one. 129.74 looks good. Okay, so since these are hard-coded, they won't change if we change the project scenario. So that's what we want. Okay, so we've set our baseline PTCs. Go back to partnership settings. Let's talk a little bit about these other inputs. So this payment rate, the actual PTCs minus this percentage of the baseline, that's an amount of credits that the investor will pay PAYGOs on. The payment rate is in here. So 1 means they'll pay $1 for every PTC that's in that difference that I described. This is usually 1, or this will change depending on the scenario. So 1 is what we're setting it to. For periodicity, you can pay annual, semi-annual, or quarterly PAYGOs. I usually see annual and semi-annual. It's typical also to delay the payment by a certain number of months. We're going to delay it by 2 months. I've seen 2, 3, 7. I've seen lots of different numbers. And then there's an end date. So usually you want the PAYGOs to end the year before the flip date. That's the default here. You want them to end the year before the flip date because things can get quite complicated when handling the flip and handling PAYGO. So the safest thing to do, just end it the year before the flip date and leave it there. This can be whatever date you want. I mean, it can go past the flip date if you want. I don't recommend setting it up that way. I'm not sure what will happen, but you can. And then there's an option to skip the first payment. This is an option that I've been asked to add, where it'll still accrue the PAYGO amounts. It'll just not pay them in the first year. It'll wait to pay them in the second year. So that's what this option does. Okay. Okay, so given all that, let's run our partnership. And we'll just stay here. And then let's just go look at the capital accounts. So that's down here. I'm not going to do a big explanation of what capital accounts are, but you can see now that we have these small contributions, skip the first year, and then all the way out to 2030, which is where our end date is. So these are our PAYGOs that we're computing, and let's have some fun. Add this up. So this is 26 down here, I'm reading 26,797, so 26.8 million total. And let's now change the partnership or the project scenario and see what happens. I would expect these PAYGOs to be lower because the amount of production is lower. And there should be less PTCs and less PAYGO resulting. Okay, so let's go back to the capital accounts tab and rerun. Stay here. And now we get 18,552. So that's a big reduction. So we switched to a lower production case, and then less generation of electricity, less production tax credit, less PAYGO paid. It was 25.8 million or 26.8 million. Now it's 18.5 million. So you can see PAYGO calculator works. So just for completeness, I'll show you what the specified input looks like. So I set this to specified. If we go to project to partnership, you can see there's specified pre-flip PAYGO. So if your project model is computing PAYGOs, just put the amounts in here and make sure they line up on the right dates. Tess will just use them. And then really this gets ignored because we're not calculating it anymore. Okay, so there's also post-flip PAYGO. I don't want to get into a long explanation of that, but what post-flip PAYGO does is it will look at, you give it an expected taxable income split, and if the resulting split after DRO reallocations, which we'll talk about soon, if the actual split after DRO reallocations is greater than this expected split, then the difference between the two is used to compute the PAYGO payments. Because what will happen in that case is that the investor will get allocated more credits than they really expected, and they'll just pay one-to-one on those credits back to the sponsor, so that it really cancels out the effect of that increased split due to reallocations. I know it's kind of complicated. I expect that if you want to do post-flip PAYGO, you already understand it and don't need me to explain it to you. Okay, so I'm going to set this back to calculate, and let's rerun just to be safe. And let's go to the dashboard. Okay, cool. So that looks good. That's how PAYGO works. Next, let's talk about preferred return. So this is, we call it preferred return. I think sometimes people call it priority return. What it is instead of just plainly splitting the partnership's cash following some percentage or some series of percentages for different streams, you say, well, take a little bit out first before splitting it and give it to one partner or the other. Typically, it's the investor. Sometimes it's a sponsor, but that's what this supports. And we, just like with PAYGO, we got 3 modes. You can specify a schedule. So let's have a look at that. And the way the schedule works is you put in a date effective, and then you put in an annual amount. So like if I say 100,000 here, and then let's say on the flip date, it goes to 0. So I want $100,000 a year of preferred return, but then on the flip date, I want it to go to 0. That's what I've set up in the schedule. And we can see the effect really clearly if we go to the allocations tab and look here. So you can see for the investor, there's this preferred return row. The annual amount is appropriately prorated to the start and end date. So since we started March of 2021, we don't get a whole year of preferred return. We just get a partial year. But then we get the entire 100,000 that we asked for until the flip year when it goes back down to 0. And what's happening is that this amount is taken out of the total, and the splits are applied to the remaining amount. So that's what this cell is showing us. If we take this preferred return and add it to this cash after waterfall, we get 3,652, and that's this value. So this amount is taken out, and then the remainder is split. So if we turn this on and look at the splits, it gets kind of interesting. So this shows 10%, because that's how much of the remaining cash is split. And you can see even the title is remaining cash. And the preferred return, this shows really a percentage of the waterfall amount that's being siphoned off to preferred return. And since the preferred return is this nice round number, but then the amounts are different numbers every year, you can see that there's kind of a different split every year here. So that's how preferred return works in Tess when you specify a schedule. There's another mode which is called percent of baseline. That's right here. So that disables this. I'm going to set this back to, just to be nice, I'm just going to set this back to 0. Okay, so percent of baseline. And this is a structure I've seen a few times. The way that it works is you'll go to the project to partnership tab. Let's hide this and go to the preferred return sections right here. And there are these two inputs, preferred return, cash baseline. So the way this works is you specify a schedule of cash amounts, and then there's an percentage that's applied to it to compute the preferred return amounts. So kind of similar to PAYGO, what I've seen is maybe you compute the P50 scenario and then put in those cash amounts. So let's do that just for fun. So now we're in P50, and then we'll go to the project model, and we'll look at maybe this total contract cash. And if I copy this, and then I go to my project to partnership, right click, and I click this button to paste the values. Because just like with the PAYGO PTCs, we don't want these to update when we change the scenario. We want them to be hard coded so that if we change to P75, these stay where they are. Okay, so now that we've set that, we can go to partnership settings. We have our percent of baseline, and 15% is going to be multiplied by each of those months every month to compute the preferred return. And we should see when we go to the allocations tab that indeed we have a preferred return that's kind of a bunch of different numbers, right? They're different every year because the totals are different every year, which kind of makes sense. Oh, something I want to point out that I forgot to mention on our last preferred return setting is preferred return only applies to the cash that's in split schedule 1. The calculation becomes, I would say, impossibly complicated when you want to apply preferred return to cash that's using different splits. I've seen people try to do this before, and it really is difficult, and it really doesn't work out well. So Tess just doesn't do it, and only the cash that's on split 1 will be available for preferred return. If you don't want it to be available for preferred return, put it in one of the other split schedules. Okay, so it's just split 1. Okay, so that's how preferred return works in Tess. I'm just going to turn it back up. Okay, cool. I'll just give a brief mention. There's also this return of capital concept, and the way this works, this is another waterfall step that comes after preferred return for cash. And what it'll do is it will give a percent of the remaining cash after preferred return to the sponsor until a total amount has been given to them. This is a structure I've seen a few times, so I wanted to include it here in Tess. I'm hopeful that if you know about return of capital, you'll understand what these inputs mean. Okay, so let's move on to our next topic, which is DRO reallocations. You can see there's other inputs here. I'm not going to do every single one. It would just take too long. I'm trying to do the most common ones. Okay, DRO reallocations. So with a DRO, really it's a DRO limit. So what we're doing is we're going to limit the amount that each partner's capital account can go negative to a certain number. So often these values are expressed as percentages of equity. So I've set this to 100% of the investor's equity contribution. And so the limit for the negative value of the capital account is this $88.8 million. And what will happen is if the capital account would go below $88.8 million, then Tess will reallocate taxable income to try and keep it at that 88.8 limit. And usually the way partnerships are structured is you don't want this to happen before the flip, and then at the flip, the DRO limit goes to 0, and you reallocate a lot of TI to the investor's capital account so that it goes from being negative to 0. That's usually the way these are structured. Okay? So that's what this DRO end date input is you have an an endpoint for this limit, and when it ends, it goes to 0. And then we have the same set of inputs for the sponsor. Okay, so 100% is a pretty big limit. If we go to this allocations tab, and I'm going to hide the split section and look at the totals, you can see there's a reallocations row. And you can also see that it's all 0 until the flip year. And in the flip year, there start to be some reallocations. And it looks like there are reallocations every year till the end, which is fine. It's okay. So this is a nice report of Tess showing you that reallocations are happening. And if we go and look at the capital accounts, we should also see the effect of them. So we allow the capital account to go negative. You can see it doesn't even get close to negative $88 million. So there's no chance that it's going to do a reallocation before the flip. And then in 2031, the capital account goes to 0 because you can see that there's this big chunk of income here. And I happen to know the TI split goes to 5%. So I'd expect to see a number kind of like this, kind of like 5%. But there's a number that's a lot bigger there because of the reallocation. And you can actually see a little bit more detail on that if we look through this report. So, for example, if I go to this taxable income splits area, let's turn on the percentages. That'll be nice. Okay, so in 2031, this is the year that we're looking at right here. You can see that the normal allocation of TI is this squirrely 17.58%. This is, again, because it's a mix of the 99% before the flip date and then 5% after the flip date. So it's a kind of a funny number. And the amount of TI allocated to the investor, if I set this back to amounts, is this about 1.1 million. Although recall, we saw a number a lot more than 1.1 million on the capital account, so we know that there has to be a reallocation. Sure enough, there's a big reallocation right here, and the resulting allocated income is almost 6 million. So that's a good demonstration of how reallocations work. If we wanted to mess up this deal, we can change this to, like, let's change the investor's limit to 30% of equity. Okay, and we'll rerun. Let's see the effect that has. Stay here, and let's go to the capital accounts. Okay, so as promised, our capital account doesn't drop below our limit. I think it hits it here. So this is 26,645. Let's look at partnership settings, 26,645. So we hit our limit in 2026, which would mean there has to be some reallocation in this year. And then if we go and look, sure enough, 2026, we would have gotten allocated negative 6.9 million, but there was a reallocation for the capital account, so we actually got allocated negative 3.4 million. So that's an important thing to note, is that reallocations can happen, and this allocations report actually is a really good place to see exactly where they're happening. One more thing I want to point out, and this is the reason why this is important to pay attention to, is if you look at these credits, this is a P1 cash tab, you can see we're getting nice, kind of consistent around 12 million in credits. And then in 2026, there's a lot less. You might be thinking, why, Luke? Why would there be less? Well, it's because of the reallocation. The rule is that if the credit split must follow the TI split. So if a reallocation happens and the TI split is not 99%, the investor is not going to get 99% of the credit. They're going to get a number that's less than that. So that is also why you tend to have the flip date be at the end of the PTC period, so that you switch from 99% to 5% after all the PTCs are over, so you can take all 99% of the credits all the way through the whole deal. So this is something to watch out for. If you have a reallocation before the flip, then you're not going to get all your credit. Okay, so let's set this back to 100, back to our nice maximum credit scenario, and let's think about our next topic. So let's DRO reallocations, and then I have one more. All right, so this one's for all the sponsors out there. This is back leverage. So Tess has a back leverage calculator, which supports a somewhat sophisticated setup of back leverage. So the way that it works is you can have 3 different scenarios of cash that you want to save. And what it'll do is, if you tell it, hey, I'm running the P50 scenario right now. So save the sponsor's cash for the P50 scenario now. When I click run, save it for P50. What Tess will do that, and it will compute a back leverage loan based on the cash that's saved and the coverage ratio that you input here. You can tell also there's this enabled. So these two sets are disabled. They're not going to be used in the calculation. If you enable another one, what will happen is you'll have to set this to, say, P75 and run the P75 scenario. Now you have two sets of cash and two different coverage ratios. Tess will use the lower of the two after the coverage has been applied. So you take the P50 cash, divide it by 1.4, take the P75 cash, divide it by 1.2, and the minimum of those, and even if you include the P99 at 1.0 coverage, the minimum of all of them will be what you use for the back leverage calculation. Okay, so that's how that works. You wanna be careful, kind of like the other ones, with managing which scenario cash is saved for. Tess doesn't really have a way to know what scenario your project model is in, but you can tell it with this input. So actually what I wanted to do was link this up to my scenarios tab to demonstrate how that would work. And if I go to my scenarios tab, this is in my sample project model. I'm sure your project model has one too. If I go here, I can see I have some inputs set up for the back leverage. All right, interest rate. So let's just set these up just for fun. And it shouldn't take too long. So I'll take this interest rate. Oh, wrong one. There, good. Save cash for scenario. So I, of course, set this up ahead of time to P50. So let's set the coverage ratio here. I'll show you in a second how the scenarios tab is going to handle this saving concept for us. So you can see in the P50 scenario, it's going to save P50, but in all the other ones, it's not going to save them. So it'll always have the P50 cash sitting in there for computing the back leverage amounts. And if you go to one of these downside cases, then it won't overwrite that cash, and the back leverage loan will be locked in where it is. Okay. Okay, so if we look at the partnership settings, these of course have turned blue because I wrote a formula in there. You can see there's some other settings. There's a periodicity. So if it's set to semi-annual, then all the cash will be collected semi-annually, and back leverage will be paid semi-annually, and cash will be distributed semi-annually also. You can also set that to quarterly. Those are your two choices. We got a start date. We got an end date for the loan. After this, the whole back leverage concept ends, and cash will come out of the partnership at whatever periodicity it's set to. Okay. Okay, so just to demonstrate that this works, let's go ahead and we'll run. And notice this back leverage amount here. This is based on our P50 cash. This is how much back leverage we can get. And if we go to our scenarios tab and change it to scenario 2, the P75 case, go back to the dashboard, rerun the model. Okay. You can see this number didn't change. We're still drawing the same amount of back leverage. And of course, it doesn't have to be P50. It can be whatever scenario you're sizing your back leverage to, or whatever combination of scenarios. But that's how Tess handles back leverage. I'll just point out also that this is the levered economics. So these returns include this back leverage. There's also unlevered economics. They assume that back leverage doesn't happen. Of course, if you sum these two, this sums to 61,643. That's the unlevered equity. Okay. Okay. Great. What else can I say about back leverage? Oh yeah. So the way it's drawn, I believe, is set. Oh, right. Okay. So the way that it's drawn, I'm back to project to partnership. If we go to contributions for IRR, so in this section, you can, if you need to carefully tune the timing of contributions and the timing of contributions, both unlevered and levered, this is where you do it. So it's defaulted right now to just use the same dates that are on the partnership settings tab. But if you need to overwrite this, and you need to say, okay, in the unlevered case, we're going to use these dates and these percentages of the total, you can do that. And then in the levered case, it uses the same dates, but you can have a different schedule for how the contributions happen. So I know that this can be helpful because you'll have situations where the timing of the back leverage draws doesn't exactly map to the unlevered contributions, and you need to fiddle around with them for it to work. So that's what this section is for, if you need it. Okay, so that does it for my partnership settings tour. As you can see, there are a lot more settings that I didn't talk about, and I'm hoping that this has been helpful for you for whatever setting you need to use, whatever's interesting to you. Hopefully, also you can find the other inputs and understand how they work. Of course, if you can't, you can reach out to us and we can help you. Okay, thanks a lot for your time, and I appreciate it, and I'll see you in our next video.